Okay, here's a little bit of like margin insanity um, for people that think they can trade with small retail accounts. When I was trading DJT, I had a lot more money in my account, and I lowered it. And right now, I only have like 68,000. But I had a really good day today, and I just closed everything. And because I have all these boxes and conversions and reversals on, um, it it perceives some kind of margin. Although I was told that that doesn't affect margin, which it shouldn't because that was riskless. And then I've been because I don't have portfolio margin anymore. I have to deal with this thing called SMA, which can't be simulated and makes absolutely no sense. Now, I used to have a Series 3, a Series 7, a Series 21, a Series 55, and a Series 63. They've expired because I don't need them anymore. But I think when I was studying for the 63 or the 55, they just come out and admit that like a lot of these Reg T laws, blue sky laws, they just don't make any sense. They were just written by committees and they make no sense. And this makes absolutely no sense. Whatever this Reg T SMA thing is, I had a position where I was completely flat. Now, you should know, and I'll go over this in the future, that puts are calls and calls are puts. Um, so if you look at this here, I had a position where this is basically I'm long 2,000 shares of stock, and there's no dividend in this stock. So you don't have to worry about early exercise for calls. The only thing you have to worry about is early exercise for puts. And because I'm long these 91 puts, like if the stock went down to like $50, I would get to exercise my puts early and save some interest. So I'm in control. I basically have this 84-91 spread on, which is called a box 20 times. And I actually looked at taking it off, and that actually increased my margin, which makes no sense to me. And I had it to the point where I had everything hedged, where I had absolutely no risk at all. The only thing that could happen was that I could early exercise the 91 puts, which would make me a little bit more money. I mean, but my SMA was minus 22,000, which puts me up for liquidation on a riskless position. I don't understand that at all. Um, it just is what it is. And I asked for the formula. There's no way to simulate it, but they wanted me, they were happier with me having being long 1,500 shares of stock naked than having a riskless position. And they were going to liquidate me if I didn't buy stock. So, you know, my margin problems are not a big issue right now. So I just bought stock and I sold 25 of the 93 calls, which is actually putting on risk. And now my SMA is not a problem and I'm not going to be liquidated. So I had a riskless position. I would have been liquidated. I put on risk that I'm not uncomfortable with. I mean, I think I'll make money on this. And if I lose money, it'll be infinitesimal. But if the stock goes up to like 94, I do really well. I mean, it's small. Um, look at my risk parameters. I am long 259 deltas, short 140 gamma. My Vegas 231. It's just infinitesimal risk, but still, if you look at my account window, um, you know, my initial margin on this is $30,000, and it's just insanity. Like I had a riskless position where the only thing that I was in control, the only thing that could happen was to, if the stock went to 50, I could early exercise my 91 puts and I can make some money. And I literally had to buy some stock and sell some calls, which is putting on risk to become compliant and not get liquidated. I don't understand that at all. Um, Whatever, I'll live. Um, the stock was actually up $3 at one point today, and I did really well getting out of it. I have another video showing what I did that I'll upload later. But this is just insane regulation for people that think that they can just, take a small account, which is, I mean, this is $68,000, and you have to deal with this nonsense. No risk, tons of margin, and I can't put on any more positions. I'm not going to close this, just to show you, like, calls are puts and puts are calls. Being long 20 and short 20, that's 2,000 long. This is 2,500 long. That makes 4,500. This is 2,900 short, which leaves 1,600 if my math is right. And that minus 400 shares, that's 1,200. So I have 1,200 shares of stock against 25 of the 93 calls. And I'll live, but it's just a waste of margin. Like, the thing is that, the reason I closed it the way I did was because I'm dealing with out of the monies, and the out of the money markets are tighter than the in the money markets. I mean, let's look at these 84 calls. They're 35 cents wide, whereas the puts are 5 cents wide. So I don't want to trade a 35-cent wide market when I could trade a 5-cent wide market. But it does have handles, and it makes absolutely no sense. But that's what I have to deal with. So if you think this stuff is easy, then good luck.